Welcome to the Holistic Accountant Podcast. The aim of this podcast is to demonstrate how accountants must employ a holistic approach to help their clients maximise wealth. It's not just about preparing tax returns. So each week, Mena Abraham and I will discuss topics to help you better understand some of the things your holistic accountant can help you with. Okay, so today Mena and I want to talk about what costs are tax deductible when you first purchase an investment property. If you're considering investing in property, I think it's really important to understand how to maximise your tax deductibility. And often we find that people are attracted to investing in property, particularly borrowing to invest in property to save tax. But I would, of course, remind people that the core reason should be to build wealth, and tax is just a positive consequence associated with the strategy. So, Mena, there's sort of two types of costs, I guess, upfront and sort of ongoing, if we sort of term it that way. Let's talk about the upfront costs.
Yeah, so that covers things such as your buyer's advocacy fees, your stamp duty, your legal or conveyancing fees on purchase, and your land transfer fees and so forth. All those type of costs are considered capital in nature, and you can't depreciate it over the term of or however long you own the property for. So what they do is they form part of the cost of the property. So when you come to sell the property and work out your capital gain, or hopefully never a loss, that's basically what you use to calculate what the actual cost of the acquisition was.
Yeah, so buyer's agency fees are a good one, a good example, because a lot of people actually initially think, well, maybe they're tax deductible because you're getting advice on, buying a property. But the law says that if any advice relates to prospective investments, not existing, pre-existing investments, then it's not deductible. It's a capital cost. What about when we make improvements or repairs to a property? In fact, actually, what happens if we go and buy an investment property and then we spend some money on it before we get a tenant?
Yeah, so if you're spending money to sort of improve the asset or repair certain items in a home prior to actually leasing it before it's available for rent, again, those costs are considered capital in nature. The only difference with those costs is that you can actually depreciate them whilst you're renting out the property. So you do get some sort of upfront payment, but it'll be spread out over a number of years.
And of course, if we spend money on a property before we get a tenant, it's always going to be an improvement, isn't it? Because we're improving it beyond the state that we purchased it at. So in some regards, if it's possible to manipulate it this way, it might be better off to put a tenant in the property and then make whatever improvements / repairs you need to do in the future if that tenant moves out, or maybe you can do it while the tenant is in there, depending on what it is. And the benefit of doing that, Mena, is...
Yeah, so for example, if you need to paint the house before you, or paint the house because there's a bit of wear and tear on the walls and so forth, if you can do that whilst the tenant is in there, you'll be able to get an upfront deduction for that. Whilst if you actually did it prior to the tenant or prior to the property being available for rent, then that's considered a capital cost, and then you have to depreciate it over a number of years.
Yeah, it's all if we're going to spend money on a property, what we're trying to argue is that it's more, where possible, it's more of a repair than an improvement, because obviously improvements need to be depreciated, whereas repairs you can write off in the year that you incur the expense. In terms of deductions, ongoing deductions after you've got a tenant, well, they're pretty straightforward, and we've done a podcast on investment property tax deductions, so certainly hunt that one down to have a look at it. But having a good accountant is key, and the key themes to that podcast were twofold. The first one is that your biggest deduction is a tax deduction is interest. So make sure that you structure your loans correctly and maintain them so that you're entitled to the full interest deduction. And then secondly, having a good property manager and having them pay for all expenses so that they're able to do all the record keeping for you helps you certainly maintain or maximise your tax deduction. That is, it's easy to miss an expense that you've paid during the year. So what you want to do is mitigate the chances of that. Then once your accountant knows everything that you spent over the year, they can then trawl through those expenses and work out, Whether they can argue to write them off in that particular year, or unfortunately, if you have to depreciate, so be it, but at least you'll get the tax deduction for the expense over the period of time. So don't be afraid, however, to spend money on due diligence before you buy a property. So whilst we're very tax focused in this podcast, it's important to obviously buy the right asset. That will make you a lot more money on an after-tax basis than just merely trying to maximise the tax benefits. So even though engaging a buyer's agent isn't tax deductible in the year that you spend the money, it's a capital cost. It doesn't mean that it's not worthwhile doing. In fact, I would argue going and spending hundreds and thousands of dollars on an investment property without any advice seems quite risky to me. Okay, that's it for this week. Until next week, bye for now.